How are you seeing this value versus momentum?
Well, the wind has been blowing towards value or relative value for quite some time now.
Are there still pockets of valuation? Are there still areas where it is underinvested or unloved in the market?
So if you look at today, the sectors which stand out are obviously private sector banks, but I think a lot of negatives are getting priced in. Valuations are also reasonable. So you have both the things.
Hi, welcome to yet another episode of Mind Over Markets. And with me today, as usual, we have Rahul Singh, our CIO for Equities. The big change is we've moved over from voice to video podcasts. Rahul, how are you finding it?
Good, it's a new experience. Thank you, Anand, for initiating this.
Okay, so getting started, I think we've seen a massive rally in the markets last couple of months, ever since we did the last one. How are you seeing this value versus momentum conundrum, and which way is the wind blowing now?
Well, the wind has been blowing towards value or relative value for quite some time now. I would say last 2 years, since November 21, when the interest rate cycle started to get hiked. And I think that we are seeing a continuation of that. And in between, we get periods of corrections and consolidation. But overall, it's been a journey of value coming back or GARP coming back over, say, quality or growth. But let me caution you a little bit on that India is a growth market. So essentially, if companies are outgrowing their sectors, they are still getting premium valuations. So I would like to just put that word of caution, saying that we have seen cases of so-called quality getting the quality valuations or premium valuations if they are able to deliver on growth and beat that sector. So it is not all gone away. It has become, I would say, the quality part of the market or the growth part of the market has become much more selective, because growth has become scarce in that part of the world, that any company or any sector which is able to still do better than the rest is still commanding those growth valuations or quality valuations. So that's the only caveat I will put. But otherwise, it's been an out and out value driven market which has got the momentum right now.
Okay, just starting right at the top, if you were to look at US markets, S&P recently hit an all-time high. So you have three broad markets. If you were to look at globally, from a global lens, you will have a rather tired bull market, which is, say, the US, which has been going on for a long time. And I think a lot of noise around recession, slowdown, etc., which has been building up. But that is nowhere to be seen. So hence a tired bull market. You have a raging bull market here in India, which where the markets have done spectacularly well, and the good run continues. And you have a vicious bear market in China, where they are hitting multi-year lows, massive erosion of market cap. I think recently read that almost $1 trillion wiped out in a fortnight. So how would you allocate monies across these three very distinct kind of geographies if you had fresh money to allocate?
Yeah, it's a very top level question, and it's a question for a global allocator of funds. But all the three things are actually related in a way, because India is in a sweet spot because China is slowing down, because it is keeping the commodity prices in check, which is good for India. Also, when China slows down, the relative growth premium over China increases, because after 3 decades, we are looking at a 3 to 5 year period where India can grow faster than China by almost 1.5–2%. I have not seen this kind of outlook in the last 25–30 years. So it's a big shift. It's a big shift, and the markets have woken up to that, and that's why you see the valuation premium, and that's why you see the pool of money shifting away from China into India. Even if the emerging market funds are seeing redemptions, you are seeing relative allocation between India and China changing, and you see that in the MSCI weightages also, which is public information. As far as the US is concerned, I think till the time the emerging markets as a class don't do well, which is practically left with only one or two countries since China has fallen by the wayside, you are still seeing US markets still being robust, relatively robust compared to other emerging markets. But I think the difference between US and India markets is that Indian markets have become very, very broad-based in the last 1 year. Because of the nature of the economic growth which we are seeing, which is investment cycle driven. So typically when that happens, the markets become broader. Whereas in US, it still remains pretty much a relatively narrow market with a handful of stocks leading the rally and keeping the markets afloat. So that's the basic difference between why I think Indian markets inherently are showing much more strength than I would say even US, because the width is that much more. And I think these are the subtle differences. But as far as comparison with China is concerned, I would say that given that China is in a structural slowdown phase economy-wise, and also that the economy as a whole does not want to grow fast as compared to what they wanted to do, that you would see this trend continuing, and you would see that India will tend to get the advantage of having a higher growth reflecting in the valuation premiums, which are not going to go away easily.
And just on China, one quick word, because valuations are lip smacking there. Do you think sympathy alone can kind of take it a little higher from where it is, just because of the very attractive valuation? Just call it dead cat bounce or whatever.
Not an expert on China, but I think it can happen. Last year, same time, there was expectation of a revival which kind of fizzled out. So you will have those periods. See, in any bull market, any structural bull market or bear market, it's never a linear story. You will always get moments of consolidation or correction in the markets which are going up, and you would have the laggards catching up. So those periods are not impossible to imagine. But whether that would be backed by any fundamental improvement in the way the world is viewing China looks difficult as of now, unless they do a complete pivot and start going the fiscal stimulus route, which so far there have been very little sign of that. Whereas if you compare that with India, practically everything in the macros which could go right is going right. So, right now we are kind of poles apart. Even if you look at the health of the banks here versus health of the banks there, health of the corporate and real estate sector, which is practically the lowest level of debt, versus health of the corporate and real estate sector in China, these are poles apart. And therefore, it'll take something very dramatic for this to change.
Closer home, how do you see relative valuation in terms of large, mid and small? And incrementally, where do you think one should allocate money?
Yes, so I think given the way the economy is positioned, where the investment cycle is reviving, typically that leads to a broader market, like I said earlier. And therefore, if you take a longer term view, 3 to 5 year view, I still think mid and small cap would continue to offer greater alpha opportunities to create outperformance as compared to large cap. That's the long term answer. But if you look at short term, there would be, like I said, pullbacks. There would be periods where mid and small caps run a little bit ahead of themselves, which seems to be happening now. And you might see a short-term period, say 1 year, 18 months, where large caps could do better. So I think we have to break it down into different time horizons. I think shorter time period, the risk reward in large caps, particularly in some parts of large cap, looks much more attractive than mid and small caps, where much more seems to be getting factored in. And therefore, we are also increasing the risk. As you start factoring in more and more of future growth, the risk also keeps increasing. And therefore, at the portfolio level today, there needs to be that cognizance of that that fact that the risk in mid and small caps have also gone up, even though the potential remains high from a 12 to 18 months perspective.
I think in terms of sectors, a stellar sector has been PSUs in the last 1.5 years or so. I think PSU index itself has done new highs. And if you were to look at the way performance has come in this particular sector, how much of juice is left here, and how do you think about it if someone were to start nibbling into PSUs? Should one be doing at this stage, or how do you think about this entire PSU space?
So the whole PSU rally or re-rating started almost 2 years back. Partly because value was coming back, like we mentioned about the higher interest rate regime. Secondly, because there were inherently some sectors within the PSU pack which were doing well, where the PSUs were doing well, which is the PSU banks to start with, then the power sector to start with, then defense kind of took off from there. So we've had actual fundamental reasons for some of these PSU sectors to do well, starting with, as I mentioned, banks, and then power and so on. And that is very, very well justified in my view, because fundamentals have changed in some of those sectors, including banks, where PSU banks, because of the systemic improvements, because of their own improvement, and because of the credit cycle, they are in a situation where they are sustainably making 1% ROA, which was unthinkable earlier. Same with power, where coal-based generation has come back, the capex cycle has come back, and defense, because of the improvement in the outlook, the order book outlook, and the fact that there is more indigenization happening. But I think today what's happening is that it's spreading to PSUs, even to those parts of PSUs where you cannot back it up with fundamentals. And that's where you need to worry. And that's where you need to cut your, limit your exposure to those PSUs where you can back it up with fundamental logic, and not really get carried away and look at PSUs as PSUs, and any PSU is a good PSU is not necessarily the way to approach things. And therefore, the idea here is to identify and stay with those PSUs where you see the fundamental triggers still playing out over the next 2 to 3 years. A lot of places it's already played out, but a lot of places we still find that we could stay with that sector or that sector's PSU for a little bit longer than what, even if the prices have gone up.
So not a broad brush, actually.
It should not be. I mean, Indian market is too broad and the economy is too wide to have a broad brush approach. But the markets behave differently. Equity markets tend to have a broad brush, simplified view of things. And therefore, you get these periods when euphoria takes over and then you have to scale back. So I suspect we are in one of those early stages of those periods where you need to take that realistic view of a lot of those PSUs which have done exceedingly well just because they are PSUs.
Understood. So here's a difficult one in a market which has run up so much. Are there still pockets of valuation? Are there still areas which is underinvested or unloved in the market, where you think opportunities can arise over the next, say, medium to long term?
Yes, I think the starting point of identifying these sectors is to look at the cases where there could be earning upgrades, where you could see companies surprising on the positive side compared to what the expectations are. So if you look at today, the sectors which stand out are obviously private sector banks, where I think a lot of negatives are getting priced in. Valuations are also reasonable. So you have both the things, coming together. So it's a calculated kind of risk reward call which you can take in that sector. And obviously different stocks are different sub-sectors are different, but that's one sector where we see that a lot of negative risks are priced in or factored in. So potential for any of those things to surprise positively is there. The second sector, which is, the second, I would say, a theme or sector where you see that the earnings have bottomed out and we are in the beginning of an upgrade cycle, is pharma, where there is a cyclical low in terms of the generic pricing, and you are seeing some improvement there, commentary improving there. So we could be in for a period of cyclical recovery there. But that's more cyclical, recovery of a down cycle which started from 2015-16 onwards. And then, so these are, two broad or, small kind of sectors which I can talk about. But then it becomes stock specific. After that, I suspect that the market will become much more stock specific once this rally has run its course. It will be a very, very bottom-up stock specific market for the next 12 to 18 months.
Okay, that brings an end to our this episode of Mind Over Markets. Thank you, Rahul, as always, and until next time, goodbye.
Thank you, Anand.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.